Welcome to the Sustainability Nugget podcast. I am Rarisu Maravi.
And I am Tosin Falansha.
On this podcast, we'll learn about sustainability by discussing various related topics while focusing on three pillars: the economy, the society, and the environment. Welcome back to another episode of the Sustainability Nuggets podcast. On today's episode, we have James Frengolniski. He is one of the co-founders of Carbon Collective, a company that focuses on solving climate change by carrying out sustainable investments. So on this episode, he's going to be telling us all about Carbon Collective, how exactly they solve climate change through sustainable investing, and how we can start benefiting from the services offered by this company. So James, welcome to the podcast. Happy to have you here.
Thank you.
Please, can you give us a brief bio of who you are and what you do?
Absolutely. So maybe I'll start with the what we do part at Carbon Collective. As you said, we're working on redirecting finance to invest in the kind of future we want to live in. And we know that that we have the technologies right now to address climate change, but we are not investing enough in that future. And it's something that we can all participate in some way or another. So we're trying to make that whole process a lot easier. I actually came to this spot through a bit of a circuitous background because I also have a background in engineering, and I spent much of my young career working on technologies. And I thought that if I just tweaked the technology well enough that we would solve the climate crisis. And as we progressed and the political entities didn't seem to be doing anything to collectively put our will towards addressing this problem, and I didn't see it even happening on the company level, I realized that we needed sort of new paradigms, new ways of shifting our attention to solving the problem, and getting our collective action to be working on transitioning to these known solutions that we have. So after we closed my former startup, which was working on fish and shrimp farms, making those less negatively impactful to the environment, we were like, well, what can we do now? And that was the start. So my background came from engineering to entrepreneurship, but always with that through line of how do we solve some of the pressing world problems of how humans relate to the environment and ways that we can be a positive impact instead of just a negative one.
Awesome. You've given us like the motivation. So can you just tell us how Carbon Collective actually work?
Yeah, so our flagship product is a online only investment advisor, sometimes called a robo-advisor. It allows us to really inexpensively build people diversified portfolios so that they can have a sound investment. But we take the entire market and we cut out the fossil fuel companies and the really high carbon emitting companies. And then we replace that portion of your portfolio with technologies that are proactively building climate solutions. So we use Project Drawdown to identify all the companies that are building, that if we took in concert, are building the solutions that would transition our economy away from fossil fuels and get us to a point where we're pulling more CO2 out of the atmosphere than we're releasing. And then we use proxy voting to pressure the remaining companies. And we see that as something that someone can do. You can open up a retirement account with us, a general investing account with us, put some of your savings there. Then you can just set it and let us use that money to help solve these problems on a reoccurring basis. It's not a decision you have to make every day. You make a one-time change, and then we can use that pressure to allocate these investments towards solutions, and I can use your shares to pressure companies. So that sort of combined ecosystem of actions, it becomes really simple. It's as easy as setting up an account and transferring over money.
Okay. So how is this different from like the ESG investments? And apart from that, like, is it like an ETF, mutual funds? Can you just explain further?
Great questions. So ESG was started, came somewhat out of the ethical investing movements in the late 80s and 90s. And it was a framework of sort of quantifying how risky a company was in relation to environmental, social, and governance concerns. And in that quantification, it was the financial industry saying, hey, we want to sort of like fit this into the way we see the world. But it was a risk score. It's not a how good is this company or how relevant is this company towards solving a particular problem, which means you get some really weird cases when you apply those filters to a holding. So if you look at like Vanguard's ESG filter, they only put companies in that meet a certain score. It's a combined score of all three of those factors. But you'll get oil companies in there. You'll get companies that have, bad track records on some fronts, but good track records on other, or just that are incompatible in any meaningful way with the kind of world in which we solve climate change. The scores themselves also don't look at the add-on effects to larger society. So ExxonMobil is in an ESG fund, even though the oil industry as a whole destroys a ton of ecosystems. The pollution from burning that kills millions of people every year. There's a lot, and it contributes to global climate change in a very meaningful way. And they produce a lot of misinformation around how we perceive this crisis. So a scoring system that has set up that this company has low risk in regards to these three categories makes it into an ESG portfolio, even though if we were looking at the kind of society we want to live in, this kind of company shouldn't be. We shouldn't be investing more in this type of issue. And the same can be true for a bank that funds these companies. It can have really good scores on paper that pass these ESG filters. That means their risk in relationship to these issues is low, but it doesn't mean that they are a good company or a proactive company. So we have this misnomer, this misconception of what ESG actually is, which hasn't been. The financial industry decided that people wanted something that was ethical, we'd give them this, and mostly since there's no other good options, people would just accept it. Now, as far as what we actually are, ETFs are a exchange-traded fund. That means that you essentially have a portfolio of stock holdings and you can buy under a single ticker on any brokerage platform. We do not have that right now. Oh, okay. We are what's often called a robo-advisor, which means that you set up an account with us and we buy shares of companies on your behalf. And we do that automatically. And when you add funds, we automatically rebalance all of that, your portfolio, so that when you add another $1,000, we buy proportionally the correct number of shares of a particular company to bring your portfolio into alignment with the target. Now, that's not to say we won't in the future, but as of right now, that is the case. That's how you become engaged. It's similar to like a Betterment or a Wealthfront in how it operates, if not how we construct our portfolios.
Awesome. And so what criteria, you've been explaining how the ESG is different, but what criteria does Carbon Collective look for in a company in order to add them to their portfolio?
Yeah, so I'll differentiate between the sort of the total market fund in which we cut out the worst of the worst and replace it with the proactive companies, and talk just about how we select the proactive companies, because I think that's where it gets really interesting. We used, as our guiding star, we use Project Drawdown. We use a few other groups as well, but it was primarily Project Drawdown's work. And they looked at what would it take using the technologies at the time. It's now a few years, about 5 years old or so. Using the technologies we only had available at that time, what would it take for us to get to a point where we're pulling more CO2 out of the atmosphere as a global ecosystem than we're releasing every year? And the really exciting part about that model was that they showed it was possible. It was possible to stay within global carbon targets. It was possible to make a transition. It was possible to do it in a way that was exciting and it wasn't like everyone goes and lives in a hut and barely eats enough to survive. This is like living a rich life that's similar to the lives we have now, but isn't using as much energy in as wasteful manner. So that's the really exciting part. The really demoralizing part of that was we need to be investing about $5 trillion every year into doing this. Oh, wow. Now, that sounds like a lot of money to you and me, but in terms of the global GDP, that's not untenable. That's not even crazy. It's a very possible amount. We have not seen the coordination on a global level towards putting that kind of resources into this transition. So the question is, where is that going to come from? Again, that's the thesis of our company. But this model was exciting. It showed what technology areas we needed to be investing in to make this happen. Now, there's a lot of those sectors that we can't invest in only because there are no publicly traded companies that are working on those particular problems. But we found every publicly traded company that was working on one of the solutions that exists. And we built a collection of climate change solutions that go into this fund. And every sector has a slightly different criteria. But on a high level, what we said is, if this company is making most of its revenue from a climate change solution, so you can't put a company like that builds gas turbine engines for 90% of its revenue and makes wind turbines for 10% of their revenue, and they don't make it in. But so on a high level, if you're making most of your revenue from a climate change solution, one of the ones indicated, you'll get on the index. Now, there's a couple more nuanced questions, like for landfill methane capture or utilities, you might have questions about, are you operating any fossil fuel plants now? Are you retiring them? There's this transitionary question I think is really fascinating. It's a little more nuanced, so we go into more detail. And this is all of our methodology is published on our website, so you can go and look exactly how we construct everything, because honestly, the financial institution industry as a whole has been really opaque about what we're willing to share. And I think that has led to people mistrusting the industry. When you look at an ESG fund and you don't know why a coal company is in the fund, it leads to a level of mistrust. And so we publish all of our methodologies on our website. So you can see what our thinking is. How did we engage in this really complicated question? We live in an imperfect world now, and we need to transition to a better world, a less harmful world. And that's not always going to be really clear. It's not going to always be really easy. So being honest about how we came up with the decisions we did is really important. So that's sort of like the why and how behind the climate index.
Is it safe to say, like, one of the criteria is looking at companies driving towards carbon negative solutions, since you actually talked about drawing out not carbon neutral, actually carbon negative?
It's so when I was told in the Project Drawdown, looking at how the global ecosystem pulls more CO2 out of the atmosphere than it releases. Mm-hmm. Direct air capture and carbon sequestration are drawdown solutions, are in there, but they don't make up the majority, and there aren't that many publicly traded companies that are working on that right now. So this is more from a systems perspective. You have two levers you can pull in reducing, in solving this problem. You can decrease the amount of carbon you're emitting, or you can increase the amount of uptake. So there's a lot of natural solutions that work on increasing uptake. There's also technical solutions like sequestration and others. And then we also just need to lower the amount we're emitting every year. And that can be done in a plethora of ways. It can be done through building efficiency, which we talked about earlier, or through, again, what we talked about earlier, advanced biofuels to decarbonize hard to decarbonize industries, where those sort of the life cycle of what you're doing is, or the systems level approach is carbon negative. But I would say that the companies that are in here are building often more efficient ways of doing things we're doing today, ways that don't require fossil fuels, because we're really bad at burning things compared to when we build things that are electric, for example. When we turn things into electrons, we can do lots of crazy sophisticated things with it. We can run computers and modulate the current and be really precise. And when we burn things, we tend to, the internal combustion engine is sort of the peak of our ability there. It's a bit of a simplification, but what I'm trying to get at is oftentimes we can have massive gains in efficiency by simply switching to something that's electric. And then on top of that, we can look at using that energy in a more intelligent way. And so I think this is not across the board, but there's, in terms of smart buildings, in terms of automation, there's been a lot of gains as we've sort of combined that with electrifying a lot of different industries, including transportation, manufacturing, and so forth. So more of the solutions are in that space, as well as recycling, agriculture, food production things as well.
Okay. So can you tell us about your climate index? I checked it, and I think that's just the portfolio, but I want you to clarify. What's the climate index here?
Yeah, so that was the old name for the Climate Solutions Fund. That was what I was talking about. That is the proactive companies. And in the core portfolio, that's what replaces the oil companies and the other high carbon industries. Are these any company that's building a solution to this problem as laid out by Project Drawdown.
So let's talk about like the current state of stocks right now. How are like the climate stocks faring in this current inflation, and with stock prices falling, how are they actually faring right now?
Yeah, I think so. If we look at from November, which was the peak of the stock market, essentially the peak of the stock market was around November of 2021 to now, there's been a massive downturn. Everyone's heard about it. Roughly speaking, people in the industry say that this is a combination of fear of inflation, fear of a recession, uncertainty around based in the war in Ukraine. And I would add that for climate tech stocks in particular, the anticipation of Build Back Better, which was that bill that we all thought was going to pass, that would be a massive infrastructure and clean energy and sustainable technologies incentive sort of wrapped in there. Looked like it was going to pass in November, and then by December we knew it wasn't going to pass, and so the stocks took a big hit in that regard. People lost a lot of confidence. However, I would sort of reiterate that this is a very short-term way of looking at it. We're looking at the immediate effects. So we were really terrified of a recession. Now all the analysts are saying if a recession comes, it's going to be a very minor one, and it's going to be a technical recession. It's not going to be felt by people in the way that we imagine, like the Great Depression is felt, or even the recessions of 2008. So I see this anxiety, and I think that it comes out of the last 2 years of uncertainty and anxiety, people playing on the stock market, people getting really excited about things and then getting really terrified. We're sort of, as we become more polarized as a nation, as we become more polarized as a world, as we become more sensitive to the various changes in what has historically been a very placid geopolitical situation, that anxiety plays out in the stock market more than what is actually felt on a day-to-day for most people.
Yeah, definitely.
So climate tech stocks right now are way down. However, in a world in which we take seriously climate change, in a world in which countries are saying we don't want to depend on oil from foreign nationals anymore, we want to have more energy independence. In that, to get there, the companies that are working on these technologies are not only more cost effective than the alternatives, but they're going to be invested in heavily. And so I see a lot of long-term growth potential for the kind of companies that end up in our portfolio.
So do you have any projections like in the next 5-10 years, or how they will perform?
Look, I'm an optimist because it's hard to wake up in the morning if I'm not an optimist. Mm-hmm. You can look into the literature and dive deep into what it means about positive feedback cycles that run away, and it can be quite terrifying. And you can look at what are realistic paths to correct this. Now those paths are they're non-linear. They have to change really rapidly. Mm-hmm. And when you have non-linear change, it's hard to see that as it's happening. You're here at the beginning, it's a really shallow slope, and then you get that inflection point and it flips. To use the non-engineering example, I think if you looked at when the introduction of the car, you saw like a few cars on the streets, and then within a matter of it was less than 5 years, you suddenly have the car, you can see no horses and buggies on the streets, and they're full of cars. So there are technological changes that we have that have really sharp inflections. Mm-hmm. And those moments, knowing that exists and that they're hard to in the moment feel, gives me a lot of hope, because I see the early signs of that for a whole number of technologies that address climate change, that are everything from battery to transportation to electrification of the grid, or switching over to clean energy, the moving around of that energy. These are at points where it's becoming more cost effective in a way that is likely to be nonlinear. Now, that means that in a period as short as 5-10 years, which is on the timeline we need this to happen, we could see a sort of reworking of our economy, and that is a big opportunity from the investment side. But it only comes when we all believe in that future.
Sure. So when you search like sustainable companies to invest in, you mostly see renewable energy companies or renewable energy related companies like maybe energy efficiency and all. What other like type of companies do you include in your portfolio?
Yeah, so the renewable energy is the obvious one that everyone talks about, but the reality is um, we also need advanced biofuels. Like the airline industry does not get to carbon zero without some type of fuel, and that fuel needs to not come from fossil fuels. So like that's something that it's a hard one to pick because there's a lot of companies out there that are making sort of more traditional biofuels, which have release more CO2 than they sequester. So you have to be careful. But a lot of really interesting, innovative, smart folks working on the problem of how you make high density fuel that is truly carbon negative. I think that we produce a ton of materials every year that need to be reused in intelligent ways. And some of them are either just energy intensive or they are very potent greenhouse gases. So the recycling of refrigerants is a really important thing that we need to be doing because refrigerants tend to be, 5,000 times more potent than CO2, of that magnitude, more potent than CO2. And we use a lot of refrigerants in, of course, refrigeration, but also in heat pumps and other technologies that we're going to need more of to be more energy efficient. So being able to not just put those into the atmosphere, but to recapture them, reuse them, or then dispose of them properly is really important. As I said, other types of recycling is important, but also what's called energy cascades. So like methane landfill capture. Methane is another really potent greenhouse gas. If you capture it and burn it, it becomes CO2, which is much less potent, and you can capture that energy. So instead of leaving stuff to rot in landfills, you can actually reduce that impact. So invest in that space. We also invest in meat alternatives and other sort of food innovations. Right now, we dedicate a massive amount of agricultural resources into feeding and raising animals, and particularly in the US, it's subsidized in very perverse ways that give you sort of like another massive source of methane or NOx in a lot of agricultural cases that is very potent. So being able to reduce that is also critical. So our portfolio is quite broad in the type of solutions that we're looking at. Even beyond, I think most people think about clean energy and clean transportation, which are both very important solutions that we look at. But then there's also the like, how do you get the materials for the batteries that we're talking about using? So what are the companies that are doing that in a responsible way? So I think we look at a wide broad. I repeat myself.
So how do you make like your services like sustainable investing accessible to low income individuals?
So the accessibility on the there's two ways that we think about making something accessible. One is, what is the cost? Is this cost prohibitive, either in terms of like what are the fees, but also in terms of what are the minimums? If you have $100,000 minimum, there's a very narrow selection of folks, and this have a very certain demographic to it who's had access to this kind of wealth in the past. And private equity is a really good example of where they do that. It's like very high check size. There's a lot of laws that sort of reinforce that. So we're actually restricted in some ways about breaking that down because as a way to protect people from risky investments or low liquidity investments, you have to be accredited, which means you already have to have the wealth. So the first thing we look at is we have no minimums. We have very low fees. We charge 0.25% of assets under management. And we're always looking at ways to keep that amount low. The second way, which is honestly something we haven't fully figured out, is how do you talk about what you do in a way that isn't about excluding? When we use certain language, we exclude people. We say you are part of the in group or you're not part of the in group. And in the financial space, it's been a really important part, I think, of their business model to make it sound so scary that you need a financial professional to navigate it. We have intentionally, in the language on our website and elsewhere, we try never to use jargon. We try never to use financial specific examples. I fall into this all the time because I have to talk to financial professionals, and then I come onto this show and I have to remind myself, oh yeah, when I talk about liquidity or some other term, which means like, how easy is it to get your money? But I use a fancy word or a word that's very jargony, it's not bringing other people. It's not saying this is something that is accessible to folks if they are unfamiliar with those terms. Which is something that I'm personally working on, and we think about as a company. Though I don't think that folks are going to look to Carbon Collective and say they're a paragon of this right now. They're the best there is. They're right. We have a lot of growth on that front.
Great. So low fees and just making sure like the communication is open for everyone.
Low fees, no minimums. I think
No
those
minimum. Yeah.
are important as
Yeah,
well.
yeah. So can you tell us did you even tell us the year you started?
Oh, we started in 2020 in November was when we brought on our first customers. So we're fairly young as a company.
So how has it grown since then?
It's been fairly exciting. We have, I don't know the exact number, but we're north of $20 million under management, and a lot of that growth has happened recently. So we've seen a lot of folks moving over. Even as the stock market has cooled off, people are excited to move their funds away from investing in fossil fuels. We've seen a really big. We just launched a 401k program. And this is really exciting for us because often in 401k programs, people don't have a lot of choice. So a 401k is a company-sponsored retirement plan. So if your company offers a retirement plan, it's often a 401k, and they'll sometimes match the money you contribute. So like a individual retirement account where there's a tax advantage to it, there's a tax advantage to putting money into a 401k, and your company will often match that money. So you'll put in some part of your paycheck and they'll put in some part, and it will be either untaxed or grow untaxed. However, in those plans, your company will select who they're working with, and there'll be a limited number of often mutual funds that you can invest in. Now, those mutual funds tend to be high fees, and they tend to be invested in sort of either broad index funds or sort of traditional portfolios, which think that oil and gas is really important and tend to not weight any renewable technologies or climate solutions technologies. So we're starting to get more employees who are saying, hey, company that I belong to, we believe you should do better. And they are pushing for having other options. And we are now one of those options that companies can choose. So that's another way in which you can get your company, leverage more than just your own money, is get your company to do this. But that has also led to a lot of growth, but I don't have those numbers on the top of my head.
So what challenges have you guys experienced so far?
Oh, I mean,
a lot.
A startup is like running up a gravel mountain. It's a lot of work, and sometimes you feel like you're scrambling. But I would say that a lot of folks, there's sort of this, there's a growing awareness that ESG in particular is not what people think it is, that there's a general conception of it's ethical investing. And then if folks do dig into it, they start to see, oh, wait, that's not the case. And those folks are really easy for us to bring on board because they see that that's a problem, that their money is still being invested in the status quo, but just a slightly tweaked status quo, where it seems like mostly folks in the financial space were like, we want to cash in on this movement more than we believe in creating this positive vision of the world. And so we're sort of up against the headwind of just that the common perception of ESG is different from the reality. And as that, now this is starting to change, so it's becoming easier, but as that perception changes and folks become aware of that, it's easier for us to say, hey, there actually are financially safe or financially intelligent alternatives to. It's dangerous to ever say something is safe. Investing is inherently risky. And I should say that as a disclaimer, that in any case, what we saw from November to now is an example of how investing is risky, but that there are smart investment decisions you can make that don't require you to put your money behind these large corporations in particular that have been cashing in on the destruction of our planet.
Yeah. So can you tell us about like customer experience and like retention rate?
Yeah, I mean, I would say that as it's the case for many startups, we use a lot of other people's technologies as a way to allow us to offer the products or offer services faster than we would otherwise, which means our experience right now is that depends on a bunch of other companies, but we are constantly improving that, and are actually this summer going to be launching a brand new web app experience for integrating with our robo-advisor. And then as far as the retention, if people move their money over, they're pretty excited about it. not everyone. A few people leave. It's either the experience is not as seamless as they'd hoped, or they meet their financial goals and they don't really in a place to be investing anymore. But for folks who do move over a retirement account or start something, they generally stick around because it is a way that they can be involved and put their money behind this change without having to sacrifice the sort of the performance or pay a lot more for that service. And then it sort of allows folks, myself included, to align those investments with our values, to know that, like, I don't have to segment. I don't need to not think about my investments. I'm like, okay, well, I bike to the grocery store, but I'm also getting additional money by folks taking land and drilling it for, without the consent of the folks living on that land, or, the other terrible things that happen in that space.
Awesome. So one last question: how can we, that's me and my audience, how can we start benefiting from Carbon Collective right now, like today?
Yeah, well, you can go to our website, which is www.carboncollective.co. And that's like a way you can set up if you can start investing and put a small amount as a recurring deposit, and it will be invested every week or month. You can roll over an old retirement account. Maybe you have a 401k from a past job that's just sitting in some mutual fund. You can move that into an IRA with us, an individual retirement account with us. You can also talk to your company and see if they're looking for a 401k program, or would consider switching to allow employees to have other alternatives. That's a way you can get everyone at your company involved and have even more of an impact. Or if you want to just see what we're about and see how we think about problems and what we're building, you can join our newsletter, because we talk about sustainable investing. We talk about what technologies are coming out in the world and our potential solutions. And we dig into some of these nuanced questions that we've been talking about here.
Thank you very much. Thank you for coming on the podcast again. Thank you to my listeners and my viewers for sticking with us till the end. You'll find all the details of Carbon Collective in the description of this podcast and the video. So remember, you can listen to this podcast on Spotify, Apple, Google Podcast, anywhere you listen to your podcast. And you can also watch the video on YouTube, Sustainability Nuggets podcast. And remember to rate us, follow us, like the video, subscribe, and continue to live consciously. And I'll see you guys in my next episode. Bye.